There's a lot of complexity around mortgage renewals as it is right now. And with the Bank of Canada just dropping a report about 2025 and 2026, you need to understand specifically how to attack and approach this so you're not losing a bunch of money in interest. So if you want to avoid the pain of paying way too much interest in mortgage costs, then this video here is for you. So here's the big picture. In a recent report published by the Bank of Canada, it suggests that over 60% of Canadians are coming up for renewal in 2025 and 2026, which is staggering. And here's the bigger point. Over 60%, which is 2/3 of people, are actually going to see their payments increase. And most of them, they're not even ready for it. So here's the good news. The BOC's recent study indicated that although we are going to see increases to the average Canadian's actual mortgage payment, it's probably not going to be as big as you thought. The original reports said that we'd see increases of like 20 to 30% on average, but the reality is it's probably going to be somewhere between 10 to 20% for most Canadians. Now, this is going to be impactful for a lot of families, especially those who are used to 1.5% or 2.5% mortgage rates. But here's why it probably won't matter as much as what people actually were thinking before. So digging into the stats, it's really interesting to pay attention to what's happened in the last 5 years. Number one, part of the reason that inflation was such a big deal is because people were also seeing wage growth, which means people were actually just making more money in 2025, 2026, and 2027 when they took out their original mortgages. This is kind of insane, but the stats actually show that the average Canadian has seen a wage increase of over 25% in the last 5 years, which will help to soften the blow, if not completely take out the blow of the increase of mortgage rates. And what's more interesting is the stress test, which was implemented back in 2016 and 2018 for most Canadians that a lot of people don't like, actually worked. Over 90% of Canadians are actually going to get rates under what they were stress tested for, which means that if they were stress tested at 5% or 5.25%, which is most people, their actual mortgage rate is going to be underneath that, which gives people a little bit of room because their incomes have grown. And of course, the rate's going to be lower. Now, the Bank of Canada estimated that over 85% of those mortgage renewals are in a position where they could actually use their financial assets to reduce the buffer of those increased mortgage rates, which basically means instead of touching their home equity, they could use some of their cash to put towards their mortgage. Or they could get creative as it relates to being able to restructure their amortization to reduce those payments, which would end up in more interest costs, but not necessarily increase your monthly payments, therefore keeping your cash flow relatively close to the same. And here's an interesting stat for all those people who are saying that house prices have fallen off a cliff. The average Canadian homeowner who bought a home 5 years ago is up $119,000 in equity, according to the study. Let's be honest, looking at this from a broad perspective, it's not ideal to see your mortgage rate go up from 2 to 4% or 2 to 4.5%, but all of those things together are going to reduce the sting of the mortgage rate renewal increases significantly. So we've set the stage for what the payment increases are. Here's how you can actually handle your mortgage renewal step by step with a complete breakdown. And the first one is really important, but the last one is the one that you're going to want to stay tuned for. All right, so the first step is actually really key, and it's so simple to do. What you need to do is know your mortgage maturity date. This is really important because typically speaking, you want to have at least a 6-month buffer before the end of your mortgage renewal. And if you know what your maturity date is, you can simply put that on the calendar. The second step, everybody should be doing this. Calculate your mortgage payment estimate at that maturity date. If you download our mortgage calculator in the description below, you can calculate an estimate as to what your mortgage payment will be at the end of the term. And if you have a general idea of what to expect, it'll be way easier to start budgeting for where you're going to be in 1 or 2 years. And step 3, and this is something that I do every single year, and so many people don't do this. Review your budget. Get clear on what your monthly spending looks like as it relates to your general expenses. Let's be honest, it's not about Disney Plus, but if you go and look at your actual bills, you're probably going to be shocked at the amount of subscription services that you're paying for every single month. Simply doing an audit of all of your current financial debts, expenses, anything that's recurring on a regular basis or could be a surprise could make a massive difference on the expectations of how your mortgage renewal is going to impact you. So the key to this is just start freeing up your cash now so you're prepared for your mortgage renewal. All right, so the fourth step is consider your options when it comes to locking in. Believe it or not, most lenders offer an early lock-in option, and some do this as a refinance. What this means is that you can potentially lock in up to 6 months before the end of the mortgage term. Now, that doesn't make sense for every borrower, and I highly recommend that you take the next step if you're thinking about locking in early, which is to talk to a mortgage broker. If you're dealing with your mortgage renewal on your own, not only do you not know the options, you might not really know how to actually structure your debt. If you talk to a mortgage broker, they might present to you options around refinancing, looking at different banks, or even debt tools that can help you save money in different areas. So that step is key, because if you don't understand the different options, don't do it on your own. Step 6 has got to be the most important out of all of these. Don't struggle. If you feel like you're in a position where you've explored your budget and life has changed and everything has gotten more expensive, then you should really be looking at your options. If it looks like the payments after you've done the above are going to cause you a lot of stress and put you over the edge, don't let that stress you out. There's always options available to you. Those could include refinancing to extend the amortization, including like other high interest debts into the actual monthly payments so that you can reduce your overall costs. Talking to a credit counselor, which should be a last step, or even a financial planner, and addressing the different ways that you can approach your debt going forward. If you feel stressed out about the fact that your costs and expenses are rising, you're not alone. Most Canadians are feeling more indebted than ever before. Credit card arrears are up, debts are increasing, which means people aren't able to make their monthly payments. So your home equity has gone up. We know most Canadians are going to feel financially stressed out, but there are different ways to overcome it, including getting ahead of your mortgage renewal and your budget. So the key points in this video are to make sure that you actually check your numbers and run your budget, as well as know specifically when your maturity date is. This way you can attack it head on, and if you need to make a change, you can restructure your debt, which my team and I can help you with. If you found this information valuable and it's reduced your stress on mortgage renewals, give me a like or hit subscribe, and we'll see you on the next one.